Effective investing doesn't require an exceptionally high IQ or insider knowledge. It demands a solid intellectual framework combined with emotional discipline. In his seminal work, The Intelligent Investor, Benjamin Graham provides precisely this framework, setting the stage for some of the most successful investors of the century, including Warren Buffett. In this presentation, we'll distill the book's key insights. Key point 1. Meeting Mr. Market. Imagine owning a stake in a business valued at $1,000. Each day, Mr. Market arrives with a valuation for your stake, which can be irrational. Graham's principle is simple. A stock represents ownership in a business, and Mr. Market's judgments aren't always rational. Invest based on your own analysis, not his emotions. Buy when he presents bargains and sell when he offers unreasonably high prices. Key point 2. Defensive Investor's Approach. Graham identifies two investor types, defensive and enterprising. Most people fit the defensive approach, creating balanced portfolios at stocks and bonds, maintain this balance through annual adjustments, and practice dollar cost averaging for the stock component. Defensive investors should seek diversification, larger firms, conservative finances, consistent dividends, and more. Key point 3. Enterprising Investors Strategy. For those seeking better returns, enterprising investing is the path. It requires patience, discipline, and in-depth analysis. Focus on undervalued assets rather than overvalued growth stocks. The criteria remain similar to defensive investors but with more flexibility on company size and diversification. Key point 4. Insisting on margin of safety. Investments always come with risk, but Graham's remedy is a margin of safety. Never buy a company for more than 2/3 of its calculated value. This principle emphasizes minimizing risk by buying with a margin of safety. Key point 5. Disconnect between risk and reward. Contrary to academic theory, Graham argues that asset prices and values can diverge. Potential returns depend on your efforts to find undervalued assets. Buying below value yields higher potential rewards with lower risk. To recap these takeaways: 1. Understand Mr. Market's emotional sway. 2. Defensive investors diversify portfolios. 3. Enterprising investors target undervalued stocks. 4. Safety margins are vital. 5. Risk doesn't always correlate with reward.